This LOS is describe different types of assets and liabilities and the measurement basis of each. In this LOS, we're basically going to scroll through the balance sheet, and the first thing that we're going to look at is current assets and current liabilities. Starting with the current assets, the first item, most liquid, is cash and cash equivalents. Don't need to give a lot of description about what cash is. The next line item is typically marketable securities. Financial assets, in general, are measured and reported at either amortized cost or fair value. Amortized cost is the historical cost, initially recognized cost of the asset, adjusted for amortization and impairment. Under IFRS, fair value is the amount at which an asset could be exchanged or a liability settled in an arm's length transaction between knowledgeable and willing parties. Under US GAAP, the definition is similar, but is based on an exit price, the price received to sell an asset or paid to transfer liability, rather than an entry price. Next item, with regards to current assets, is trade receivables. They are typically reported at net realizable value, an approximation of fair value based on estimates of collectability. Several aspects of accounts receivable are usually relevant to an analyst. First, the overall level of accounts receivable relative to sales, a topic to be addressed further in ratio analysis and other LOS, is important because a significant increase in accounts receivable relative to sales could signal that the company is having problems collecting cash from its customers. We're just going to spend some more time looking at trade receivables and the allowance for doubtful accounts. The allowance for doubtful accounts reflects the company's estimate of amounts that will ultimately be uncollectible. Additions to the allowance in a particular period are reflected as a bad debt expense, and the balance of the allowance for doubtful accounts reduces the gross receivable amount to a net amount that is an estimate of fair value. Bad debt expense is an expense of the period based on a company's estimate of a percentage of credit sales in the period for which cash will ultimately not be collected. When specific receivables are deemed to be uncollectible, they are written off by reducing accounts receivable and the allowance for doubtful accounts. The allowance for doubtful accounts is called a contra asset because it is netted against, i.e. reduces, the balance of accounts receivable, which is an asset account. Okay, so I didn't put the sales account here, but I can. When we initially do a sale, we're going to credit sales and we're going to debit accounts receivable, okay? And then it's saying at the same time, if it's a credit sale, we need to recognize a bad debt expense. How do we do that? We're going to debit the bad debt expense. We're going to credit the allowance for doubtful accounts. So you can see the allowance for doubtful accounts is an asset account, but the normal balance is a credit balance, and that's why we call it a contra asset, because the fair value is the accounts receivable less the allowance for doubtful accounts. Then when we have a write-off, we know a customer is not going to be able to pay us, then we're going to credit the accounts receivable. The accounts receivable balance is going to go down, left side minus right side. If that's our credit, what's our debit? Our debit is allowance for doubtful accounts. So that's just a quick little summary on the debits and credits with regards to sales. Credit sales, debit accounts receivable, debit bad debt expense, credit allowance for doubtful account. When we have a write-off, credit accounts receivable, debit the allowance for doubtful accounts. So let's do a practice question to check our understanding. Here we have a table in millions of pounds. In 2011, we had accounts receivable gross 4,840. In 2012, that balance was 6,620. The allowance for doubtful accounts in 2011 was 56, and the balance in 2012 was 92. The write-offs during the year in 2011 was 42, and in 2012 was 84. Based on the above information about a company's trade receivables, the bad debt expense in millions for 2012 is closest to A, 36 million pounds, B, 84 million pounds, or C, 120 million pounds. Okay, to solve this question, I set up my trustee T accounts, and here's my allowance for doubtful accounts, and we know that we have a 2011, the beginning of 2012, the end of 2011 was the beginning of 2012, we had a balance of 56, so that's our opening balance, it's a credit balance. Then we were given write-offs during the year. Remember, that's going to be a credit to accounts receivable, but a debit for allowance for doubtful accounts. So we did that on the previous slide, okay? And then we have a closing balance of 92 in the allowance for doubtful accounts, which we have down here. So we know it's asking us about the bad debt expense. Recall the bad debt expense is going to be debit bad debt expense and credit the allowance for the doubtful accounts. So this is a typical CFA 101 question, 1, 2, 3, 4 variables, given 3, solve for the fourth. So we know it's 56 plus x minus 84 equals 92. You're just solving for x. X equals 92 plus 84 minus 86 equals 120. So the correct answer is C, 120 million pounds. So again, I highly encourage students and candidates to be up to speed on the T accounts. They're very useful for solving this type of question. And then you have to realize there was some information here, red herring information, you didn't need to solve the question, and that's often the case as well for the CFAs. They give you too much information. You have to be able to quickly filter out what you need and what you don't need, and that's why the beauty of the T accounts, if you have a strong understanding of your debits and credits, allowance for doubtful accounts, accounts receivable, bad debt expense, this question is, with regards to the CFA continuum, quite an easy question in my opinion. The next current asset that we're going to look at is inventories. And by the way, there's an entire reading on inventories for the CFA Level 1, so we're going to see a lot more of this in detail. This is just going through it for the first time. But inventories are measured at the lower of cost and net realizable value under IFRS, and the lower of cost or market value under US GAAP. So that's an important distinction to understand. The cost of inventory comprises all costs of purchase, costs of conversion, and other costs incurred in bringing the inventories to the present location and condition. The following amounts are excluded from the determination of inventory costs: abnormal amounts of wasted materials, labor, and overheads; storage costs unless they are necessary prior to a further production process; administrative overheads and selling costs; standard costs, which should take into account the normal levels of materials, labor, and actual capacity. The standard cost should be reviewed regularly to ensure it approximates actual costs. So that's a little bit of cost accounting, managerial accounting. The retail method, in which the sales value is reduced by the gross margin to calculate cost. An average gross margin percentage should be used for each homogeneous group of items. A quick little practice question to check our understanding. Is the reversal of an inventory write-down permitted under US GAAP, generally accepted accounting principles, and International Financial Reporting Standards, IFRS? A, no, under both; B, yes, under both; or C, yes, under IFRS, but not under US GAAP? The correct answer is C. The reversal of an inventory write-down is permitted under IFRS, but not under US GAAP. Continuing now with inventories. When inventory is sold, the cost of that inventory is reported as an expense, cost of goods sold. So you can see there's two big things with regards to inventory. One is the initial recognition of the asset. There are certain costs that can be included and not included. And then when the asset is sold, the inventory is sold, how it is expensed, there are different methods, okay, which will affect that expense of the cost of goods sold, and therefore also your inventory values that are left on the balance sheet. IFRS allows only the first in, first out, FIFO, weighted average cost, and specific identification methods. Some accounting standards, such as US GAAP, also allow last in, first out, which is LIFO, as an additional inventory valuation method. The LIFO method is not allowed under IFRS. Put that in bold. Don't worry, there's going to be lots more about LIFO to FIFO in the reading on inventories in the CFA Level 1. And finally, looking at some other current assets would be such things as prepaid expenses like prepaid rent. We would credit cash, debit prepaid rent, it's a prepaid expense, and deferred tax assets are classified as an other current asset. Current assets and current liabilities. Now we're moving to current liabilities. Current liabilities are those liabilities that are expected to be settled in the entity's normal operating cycle, held primarily for trading, or due to be settled within 12 months after the balance sheet date. And some examples of current liabilities: trade payables, also called accounts payable, notes payable, accrued expenses, and deferred income, also called deferred revenue and unearned revenue. When a company receives payment in advance of delivery of the goods and services associated with the payment. So sometimes accounting, as I've always said, the CFA test is sometimes an English language test, in this case subject accounting. Just be careful. Deferred income can also be called deferred revenue or unearned revenue. 3 different terms explaining the same thing. Now we're moving to the non-current categories, and we're starting with the non-current assets. So the first is plant, property, and equipment, PP&E. While IFRS permits companies to use the cost model for some classes of assets and the revaluation model for others, the company must apply the same model to all assets within a particular class of assets. US GAAP permits only the cost model for reporting PP&E. Under the cost model, PP&E is carried at amortized cost, which is the historical cost less any accumulated depreciation or accumulated depletion and less any impairment losses. Historical cost generally consists of an asset's purchase price, its delivery cost, and any other additional costs incurred to make the asset operable, such as cost to install a machine. Depreciation and depletion is the process of allocating, recognizing as an expense, the cost of a long-lived asset over its useful life. Land is not depreciated. Because PP&E is presented on the balance sheet, net of depreciation and depreciation expense is recognized in the income statement, the choice of depreciation method and the related estimates of useful life and salvage value impact both the company's balance sheet and income statement. Continuing with property, plant, and equipment, impairment occurs when the asset's recoverable amount is less than its carrying amount, with terms defined as follows under IFRS. 1. The recoverable amount is the higher of an asset's fair value less cost to sell and its value in use. The fair value less cost to sell is the amount obtainable in a sale of the asset in an arm's length transaction between knowledgeable willing parties, less the cost of the sale. And the value in use is the present value of the future cash flows expected to be derived from the assets. So this is important. When impairment occurs when the asset's recoverable amount is less than its carrying amount. So the carrying amount is on the balance sheet. The recoverable amount, you have to do 2 calculations. It's the higher of the asset's fair value less cost of sale and its value in use, and the value in use is doing a present value of the future cash flows expected to be derived from the asset. So these type of questions usually take 1 or 2 practices to work your way through and determine is the asset impaired. If it is impaired, then we have to take an impairment charge. When an asset is considered impaired, the company recognizes the impairment loss in the income statement. Reversals of impairment losses are permitted under IFRS, but not under US GAAP. So again, another difference between IFRS and US GAAP. Let's do a practice question to check our understanding. A company recently purchased a warehouse property and related equipment, shelving, forklifts, etc., for 50 million euros, which were valued by an appraiser as follows. The land was 10 million euros, the building was 35 million euros, and equipment 5 million euros. The company incurred the following additional costs in getting the warehouse ready to use. 2 million euros for repairs to the building's roof and windows. €500,000 to modify the interior layout to meet their needs, moving walls and doors, inserting and removing partitions, etc. And €100,000 on an orientation and training session for employees to familiarize them with the facility. The cost to be capitalized to the building account in millions for accounting purpose is closest to A, 37 million euros, B, 37.5 million euros, or C, 38.5 million euros. Okay, the correct answer is B, it's 37.5 million euros. The capitalized cost of the building would include the other costs that are directly attributable to the building and are involved in extending its life or getting it ready to use. So we had the initial cost of the building, 35 million euros. We had the repairs to the roof and windows, 2 million euros, and we had the modifications to the interiors of €500,000. So the correct total cost was 37.5. You can see We were not including the $100,000 on orientation and training. Continuing with non-current assets, we'll now look at investment property. Some property is not used in the production of goods and services or for administrative purposes. Instead, it is used to earn rental income or capital appreciation or both. Under IFRS, such property is considered to be investment property. Note that US GAAP does not include a specific definition for investment property. Now we'll move to intangible assets. Intangible assets are identifiable non-monetary assets without physical substance. So that's the important word there. There's no physical substance to intangible, they're intangible. For each intangible asset, a company assesses whether the useful life of the asset is finite or indefinite. Amortization and impairment principles apply as follows. An intangible asset with a finite useful life is amortized on a systematic basis over the best estimate of its useful life, with the amortization method and useful life estimate reviewed at least annually. Impairment principles for an intangible asset with a finite useful life are the same as for PP&E. An intangible asset with an indefinite useful life is not amortized. Instead, at least annually, the reasonableness of assuming an indefinite useful life for the asset is reviewed and the asset is tested for impairment. So continuing with identifiable intangibles, under IFRS, identifiable intangible assets are recognized on the balance sheet if it is probable that future economic benefit will flow to the company and the cost of the asset can be measured reliably. Examples of identifiable intangible assets include patents, trademarks, copyrights, franchises, licenses, and other rights. Identifiable intangible assets may have been created internally or purchased by a company. Costs related to the following categories are typically expensed under IFRS and US GAAP. They include internally generated brands, mastheads, publishing titles, customer lists, etc., startup costs, training costs, administrative and other general overhead costs, advertising and promotion, relocation and reorganization expenses, and finally, redundancy and other termination costs. Moving on now to goodwill, which is another intangible asset. When one company acquires another, the purchase price is allocated to all the identifiable assets, tangible and intangible, and liabilities acquired based on fair value. If the purchase price is greater than the acquirer's interest in the fair value of the identifiable assets and liabilities acquired, the excess is described as goodwill and is recognized as an asset. Under both IFRS and US GAAP, accounting goodwill arising from acquisitions is capitalized. Goodwill is not amortized, but is tested for impairment annually. If goodwill is deemed to be impaired, an impairment loss is charged against income in the current period. Analysts should distinguish between accounting goodwill and economic goodwill. Economic goodwill is based on the economic performance of the entity, whereas accounting goodwill is based on accounting standards and is reported only in the case of acquisitions. Economic goodwill is important to analysts and investors and is not necessarily reflected on the balance sheet. Instead, economic goodwill is reflected in the stock price, at least in theory. So continuing with non-current assets, now we're going to look at financial assets. Now this is an important slide. Sometimes students and candidates can get confused between marketable securities that we're holding on to on the balance sheet under current assets and financial assets. Now financial assets, some of them are classified as non-current assets. So that's important to understand that. And then we have to look at the measurement of those financial assets. Some are measured at fair value. For example, financial assets held for trading, stocks and bonds issued by another company, and assets, financial assets that are available for sale are also measured at fair value. And we've seen this before in previous LOSs, and we'll probably see it again, that when we buy a financial asset, it's our intention at the time of the purchase of what the classification or category is. So we have to categorize it as either something that's held for trading or available for sale. Other financial assets that are held at measured at fair value are derivatives and some non-derivative instruments. Financial assets that are measured at cost or amortized cost are unquoted equity instruments, so there's no quoted price. Held to maturity investments, those are bonds issued by another company and they're intended to be held to maturity. So as we've seen before, as I mentioned in previous LOS, these are held on the balance sheet at cost and amortized cost if they were bought at a discount or a premium. And loans to and receivables from another company are also held at cost or amortized cost. Now this slide may be familiar to you. I've used it before with regards to the LOS on other comprehensive income. And so I just wanted to show you again, non-current assets, we're talking about financial assets, and they can be classified as either for trading, available for sale, or held to maturity. And in the example with regards to the other comprehensive income, we could see that we had an asset and there was a financial asset. There was an unrealized gain on the security of $2 million. So it was unrealized. If it's in a trading portfolio, it's going to run through the income statement. We had an unrealized gain, and that's flowing through to the retained earnings. If it was classified, that financial asset is available for sale, then again, the asset is held at fair value, so the unrealized gain is recorded. A has gone up, so E has to go up. But because it has been classified as available for sale, it's not going through the income statement, but it's going through this equity item called accumulated other comprehensive income. Then finally, held to maturity, because it's held at cost or amortized cost, the unrealized gain is not recorded, so A does not go up, E does not go up, and obviously it's not running through the income statement. So a quick practice question to test on that last concept. Which of the following is the least appropriate accounting treatment for marketable securities under IAS number 39? So we have three columns here: category, measurement method, and the third column is realized gains and losses reported in. So A, the category is trading, the measurement method fair value, and the realized gains and losses reported in income statement. B, held to maturity category, measurement method amortized cost, realized gains and losses reported in the income statement. And finally C, category C, is available for sale, measurement method is fair value, and the realized gains and losses reported in equity. So again, the question is, which of the following is the least appropriate accounting treatment for marketable securities? Okay, I really like this question because it shows you on the CFA exam, you have to read very carefully, laser-like precision with a high attention to detail with regards to some of the wordings. And I've put into the red box the word realized. So the correct answer here is C. The least appropriate accounting treatment for marketable securities for realized gains and losses available for sale. Yes, they're held at fair value. But when it's a realized gains and losses, everything runs through the income statement. All realized gains and losses run through the income statement. Okay? So all categories treat realized gains and losses in the same way. They're reported on the income statement. It is the unrealized gains and losses that are included in other comprehensive income and equity for available for sales securities carried at market value. Okay? So read carefully. If it said unrealized, then B would be the least appropriate. But in this case, A is true, B is true, and C is false. So turn those least likely and most likely into true or false questions as well. And that's a way to come up with the false, which is the least appropriate. Another practice question to check our understanding. The unrealized gains and losses arising from changes in the market value of available for sale securities are reported under U.S. GAAP and International Financial Reporting Standards in the A, equity section for both, B, equity section for U.S. GAAP and the income statement for IFRS, or C, income statement for U.S. GAAP and the equity section for IFRS. Okay, that should be a pretty easy question. A is correct. Under both U.S. GAAP and IFRS, the unrealized gains and losses arising from carrying available for sale securities at market value are reported in equity as part of accumulated other comprehensive income. Another practice question. A company reported net income of $400,000 for the year. At the end of the year, the company had an unrealized gain of $50,000 on its available for sale securities, an unrealized gain of $40,000 on held to maturity securities, and an unrealized loss of $100,000 on its portfolio of held for trading securities. The company's comprehensive income in dollars for the year is closest to A, $350,000, B, $390,000, or C, $450,000. Okay, C is correct, and this is very important to understand that comprehensive income equals net income plus other comprehensive income, NI plus OCI. Other comprehensive income will include unrealized gains or losses on available for sale securities. Net income already includes the unrealized gains and losses in trading securities, while securities classified as held to maturity are maintained at historical cost, and therefore the unrealized gains won't impact comprehensive income. So again, the other comprehensive income equals $50,000, so the comprehensive income equals net income plus the other comprehensive income equals $400,000 plus $50,000 equals $450,000. The correct answer is C. Another practice question. Assume a company has the following portfolio of marketable securities, which was acquired at the end of 2009. So there's two categories, held for trading and available for sale. The original cost in euros, as at the year-end 2009, held for trading 12 million euros, available for sale 17 million euros. The fair market value in euros at the end of the year for 2010, the held for trading was 12,500,000 euros and available for sale 16 million euros. If the company reports under IFRS instead of US GAAP, its net income will most likely be A, the same, B, 500,000 lower, or C, 500,000 higher. Okay, that's a good little practice question to check our understanding. The correct answer is A. Whether securities are classified as held for trading or available for sale, they are measured at their fair value on the balance sheet. All gains and losses on held for trading securities are reported on the income statements. The unrealized gains and losses on available for sale securities are reported in equity. However, this treatment is the same for both IFRS and US GAAP reporting. So that's an important point to remember, that for available for sale securities, they're recorded at fair value. The unrealized gains and losses is running through other comprehensive income, and that treatment is the same for both IFRS and US GAAP reporting. Another practice question. The following information is from a company's investment portfolio. So the investment, the classification is held to maturity. The market value, 31st December 2014, is $17,000. The cost, amortized cost, on 31st of December 2014 is $22,000. The market value on 31st December 2015 is $10,000, and the cost, amortized cost, on the 31st December 2015 is $20,000. If the investment is reclassified as available for sale as of 31st December 2015, the balance sheet carrying value of the company's investment portfolio would most likely A, remain the same, B, decrease by $10,000, or C, decrease by $12,000. Okay, this is a good practice question because, again, they're giving you some information in this question that you don't need. They're giving you some data that you don't need. So you have to be able to quickly filter out what do I need, what do I don't need, and do the calculation fairly quickly. So the correct answer is B. Held for trading and available for sale securities are carried at market value, whereas held to maturity securities are carried at amortized cost. If the investment is reclassified as available for sale in 2015, the carrying amount should be adjusted to its market value, which is $10,000, and compared with the amortized cost of $20,000, it's a decrease of $10,000. So the correct answer is B. Now we're moving on from non-current assets to non-current liabilities. So we're going to look at long-term financial liabilities. Typical long-term financial liabilities include loans, i.e. borrowings from banks, and notes or bonds payable, i.e. fixed income securities issued to investors. Liabilities such as loans payable and bonds payable are usually reported at amortized cost on the balance sheet. At maturity, the amortized cost of the bond, the carrying amount, will be equal to the face value of the bond. For example, if a company issues a $10 million bond at par, the bonds are reported as a long-term liability of $10 million. The carrying amount, amortized cost from issue to maturity, remains at $10 million. As another example, if the company issues 10 millions of bonds at a price of $97.50, a discount to par, the bonds are reported as a liability initially at $9,750,000. Over the bond's life, the discount of $250,000 is amortized so that the bond will be listed as a liability of $10 million at maturity. Similarly, any bond premium would be amortized for bonds issued at a price in excess of face or par value. And we're going to look at that in more detail on the next few slides. In the CFA Level 1 program, we're going to look at this calculations for the bonds again, but because we're talking about the balance sheet and non-current liabilities and talking about bonds, it doesn't hurt for us to go through it at this point, because every time you go through it, it gets easier and easier. So the first case that we're looking at is accounting for a bond issuance when the bond is issued at par. So in this example, we have the face value of a bond of £1 million. The coupon rate is 5% and the market rate is 5%. So we're going to learn that when the market rate equals the coupon rate, then the bond is being issued at par. So therefore, the coupon payment is going to be £50,000 a year. And this is an annual pay bond, not semi-annual. The term is 5 years. And therefore, we can calculate our price of a bond. And this is how we come up with the initial recognition value. I can bring up my calculator here very quickly. And it's in the ending mode. And the periods per year we can check. Second PY, I'm set for 1. Annual payments, that's good. So we're going to do 5N. The interest rate is 5 as well, 5IY. And the coupon payment is $50,000. I'm going to make that as a payment. And the face value is $1 million. I'm going to make that the future value. So when we compute the present value, yes, we get our $1 million. Now, in this case, I made the coupon payment and the face future value is positive. The signs have to be the same, okay? So that's good. So just want to go through a little bit of the T accounts and the debits and credits, etc. So when we initially issue the bond, because it's at par, we're going to debit cash. We got £1 million, and we're going to credit the bond payable. Now, we know that the interest expense is, in this case, is going to be the same as our coupon payment. So we know the bond is for 5 years, 1, 2, 3, 4, 5 years, okay? So we're making an annual coupon payment, which means we're crediting cash. So we're going to credit cash, £50,000, and we're going to debit the interest expense. So here I just did the journal entries. Some students like T accounts, some students like journal entries, different strokes for different folks. So we can see here we just went through debit cash, credit the bond payable, debit interest expense, credit the coupon payment year by year. And then finally, when the bond matures, I'm going to credit my cash, the £1 million, and I'm going to debit my bond payable. And of course, I have no further liability. Okay, so that's just the quick accounting for a bond issuance issued at par. It's fairly straightforward, easy to understand. Okay, now we're going to look at the accounting for a bond that's issued at a discount. So we're looking at the same bond here. The face value is £1 million. The coupon rate is 5%. So the annual coupon payment is £50,000, and it's a 5-year bond with an annual payment, okay? But in this case, the market rate has increased to 6%. So when we issue the bond, we're not going to receive £1 million. We're going to receive a lesser amount because we have to sell it at a discount because the interest rates have increased. So let's just bring up the calculator here very quickly and redo our calculations. We can see that it's still 5N, but the interest rate is increased to 6%. Our payments are still £50,000, and the face value, future value, is still £1 million. So that we make that as our future value. And we're going to compute our present value. You can see we get 957,876.36. So that's the actual cash that we receive, 957,876.36, when we issue the bond. And when the bond matures in 5 years, it's going to have a carrying value of $1 million. The liability is $1 million, and that's why we're going to learn in further readings that the bond gets what's called pulled to par. Okay, so down here I've just made a little bit of a table which shows the debits and credits a little bit, and just to show you the amortization of the bond. So when we issue the bond, we're going to receive that cash, 957,876.36, but we have the bond payable of £1 million. So we need to make an adjusting entry, and we can see we received less cash, so the asset is lower than the liability, which means we're going to have a debit balance in the discount bond payable of the $42,123.64. Then, as I've said before, the coupon payment never changes. That's cash. So as we head into the first year, the credit to cash is $50,000, but our interest expense is $57,472.58. How did we calculate that? We're looking at the bond carrying value times the market rate. So again, if I bring up my calculator and I make that a positive and I multiply that by 0.06, you can see that my interest expense is $57,472.58. So again, it's the carrying value. My interest expense is the carrying value times the market rate. Okay, and you can see that the my debit is higher than my credit. So I'm going to credit the discount bond payable account. So the balance in my discount bond payable account is coming down, and so therefore the carrying value is going up. That's how it's being pulled up towards the par. Okay, so you can run through that again for another year if you wanted. You can see here my carrying value is now 965,348.94. If I bring up my calculator and just move it over for us a little bit, and I can look 965,348, sorry, 348, just do a little bit of rounding, times 0.06, you can see 57,920. And therefore, there's my interest expense for the second year, 57,920.94. Again, it's the carrying value of the bond times the market rate. Again, it's very easy to understand my coupon payments. They never change. It's always $50,000. That's a credit to cash. So debit my interest expense, credit cash. The difference has to be the amortization of the discount on the bond. So you can see what's happening. We're starting with a carrying value of 957, but as we amortize the bond, we're being pulled to par. So finally, our ending carrying value is $1 million. And what's going to happen when the bond matures? We're going to credit cash, the $1 million. We're going to debit the bond payable, $1 million, and we don't have the liability anymore. So I'm just carrying on with this bond that's issued at a discount. This is just, again, there's different strokes for different folks. So this slide is just showing the T accounts and the journal entries. So again, the journal entries, when I issue the bond, debit cash, 957,876.36. I'm going to credit the bond payable. So you can clearly see my debit's got to equal my credits. It's a debit balance to the discount on the bond payable. Here on the T accounts, I can show you there's my debit to cash, there's my credit to my bond payable, and there's my debit to my discount bond payable. And then, as I said, in year one, I've got the interest expense, 57,472.58. We showed you that is the bond carrying value, which was the cash that we received, times the 6%. And that's a debit to the interest expense. It's always a credit to the cash on the coupon. So I can see in this case, my debit is greater than my credit. So to make it balance, I need to credit my discount bond payable. And so what's happening in that case, the balance is going down in that account. And so my the carrying value of my bond is increasing from 957,876.36 to 965,348. I'm being pulled towards the par. So again, on this slide, it's all the same data as the previous table, but I've just put it into the debits and credits and my T accounts for the general ledger accounts, and again showing the ending carrying value as it's being pulled to par. Just one last point that I want to make with regards to issuing a bond at a discount. Note that the amortization of the bond discount is a non-cash expense. The interest expense is greater than the cash coupon, so you need to add that back to the operating cash flow. So this comes up when we look at the CFA reading on cash flows and the cash flows to operations. Most people are familiar with net income, add back depreciation, subtract gains on sale of equipment, or add back the losses. But another important item is this amortization of bond discounts or premiums. So you can see that our interest expense was greater than our cash coupon payment. So what do we need to do? We need to add back that discount on the bond payable amortization. So this is I put this slide in just to reinforce that when we look at cash flow from operations, there's an adjustment that needs to be made with regards to these amortizations of discounts and premiums. What would we do with the premium? If it was issued at a premium, we would subtract that from the operating cash flow because our interest expense would be less than the coupon payment, and we're going to see that in the next slide. So now we're going to look at the accounting for a bond that's issued at a premium. So again, we're using the same example. The bond has a face value of £1 million. The coupon rate is 5%, so the annual coupon payment is $50,000. It's for 5 years and it's annual pay. But in this case, the market rate has gone down to 4%. So when we bring up the calculator again, let's do our calculation. So it's 5N. The interest rate, though, has gone down to 4%. So it's 4IY. Our payment is still the $50,000. And our future value, face value, is the £1 million. Okay? So when we calculate our price of our bond, the cash that we received, we can see that it's $1,044,518.22. Okay? So in that case, that's the cash that we're going to receive, which we know is more than the face value or the future value. So in this case, we're receiving more cash. You can see that we're going to be pulled down to par over as we amortize the bond. So this is a similar table. Let's go through it. I'm going to issue the bond. I'm going to debit cash $1,044,518, and I'm crediting the bond payable. You can see in this case, my debit is higher than my credit, so I'm going to credit the bond premium. It's going to be a credit balance of $44,518.22. And again, as I make my coupon payments every year, that's going to be a credit. Credit my coupon payment, £50,000. But what about my interest expense? Remember that we said our interest expense is based on the carrying value times the market interest rate. So if I bring up my calculator here and I make that a positive and I multiply that by 4%, we can see that the interest expense in the first year is $41,780.72. And I've rounded that 728. So you can see here, that's my interest expense, $41,780.73. That's a debit. But you can see my credit is $50,000 on the £50,000 because that's a credit to cash. So my debits are less than my credits. So I'm going to debit the discount bond, the premium bond payable account, 8129.27. So that's a very similar exercise. And you can see I started with a credit balance, but now I'm debiting the account. So that balance is going down. And so my face value is going down, okay? And it's being pulled towards the par. Okay, this is the same data from the previous slide. We're just looking at this bond that we've issued at a premium. On the top here, I've got my journal entries. On the bottom, I've got my T accounts, my general ledger accounts, and on the right-hand side, my chart. and I'm showing the ending carrying value as it's being pulled down to par. So let's just go through it very quickly. I issued it at a premium, so I received 1,044,518.22 pounds. That's a debit to cash. I'm going to credit my bond payable, $1 million. You can see my debits are greater than my credits. So as I said, I'm going to credit the account premium bond payable. Then my interest expense, recall, is based on my carrying value times the market rate. And we did that calculation. The interest expense was 41,780.73. I'm crediting the cash. The coupon payment never changes. Credit cash 50,000, credit cash 50,000, credit cash 50,000 5 times. So you can see my interest expense is lower than my coupon payment, so it must be a debit to that account. So you can see that down here in the T accounts as well. I'm going to debit my initial cash, credit my bond payable $1 million, but my debits is greater than my credits, so it has to be a credit to the premium on the bond payable. And then as I scroll through, I'm going to credit my cash, 50,000. I'm going to debit my interest expense. It's a debit to the premium, so you can see this balance is going down, and so the carrying value of our bond is starting at 1,044,000, and it's being pulled down to par. So this is very important to understand the accounting for a bond issuance. Par is very easy. Discount and premiums, we have to look at our debit on cash, our credit, our bond payable is always the face value, but then we either have a debit if it's at a discount or a credit if it's at a premium, and then our interest expense is not matching our coupon payments, so we have this amortization on the discount or premium, and if it's at a discount, we're being pulled up to par. If it's at a premium, we're being pulled down to par. And as I mentioned, with regards to the cash flow from operations, these amortizations on premiums and discounts are non-cash items, so they have to be added back or subtracted. Okay, this is a nice little summary of all the accounting, all the debits, credits with regards to issuing bonds at a discount or premium. This has been a very long LOS. We just have one slide left. Okay, this is the last slide for this LOS. We know it's been a long one. We're on the 37th slide and we're past 45 minutes. So this is pretty much the longest LOS video. So finally, we're finishing with non-current liabilities. We're looking at deferred tax liabilities. Deferred tax liabilities result from temporary timing differences between a company's income as reported for tax purposes, taxable income, and income as reported for financial statement purposes, which is reported income. Don't worry, there's an entire reading on income taxes. We're going to get into this in more detail. Deferred tax liabilities result when taxable income and the actual income tax payable in a period that it's based on, it is less than the reported financial statement income before taxes and the income tax expense based on it. Deferred tax liabilities are defined as the amounts of income tax payable in future periods in respect of taxable temporary differences. And in this case, they're non-current liabilities. And that's the last slide for this LOS. I know it's been a long one. Thank you very much.